If you hold money overseas, maybe a bank account from before you immigrated to the US, or a family inheritance, or an offshore investment, there is one legal question that matters more than how much money you actually have. That question is, what was your intent? Hey everyone, welcome back to the channel today. We are going to look at the difference between willful and non-willful conduct in relation to foreign asset reporting. Let's dive in. According to the IRS, your state of mind when you filed or failed to file your taxes is the single biggest factor separating a minor manageable fine from complete financial catastrophe. A simple misunderstanding can mean a clean slate, while a willful level can wipe out half of your savings or even lead to criminal prosecution. Today, we are breaking down exactly how the government determines your taxpayer intent in plain English so you can know where you stand. Let's start with the good news. The IRS defines non-willful conduct as an error due to negligence, inadvertence, mistake, or a good faith misunderstanding of the law. In layman's terms, you messed up, but you didn't mean to. Here are a few classic examples. Example 1. You genuinely had no idea that US citizens and green card holders must report their worldwide income, not just what they earn in the US. Example 2. You tried your best to report the foreign asset, but misread a confusing threshold or filled out the wrong form. Example 3. Your accountant never asked if you had offshore assets, and you didn't know it was something you needed to bring up. But here is the catch. I didn't know is not a get out of jail free card. The IRS uses a reasonable person test. They look at your education, your job, and your financial background, and they ask, would a reasonable person with this background have made the same mistake? If you are a sophisticated investor, the IRS expects you to exercise a higher level of diligence than a regular person who just inherited a small amount of money from a grandparent. Now, let's flip the coin. What does it mean to be willful? Most people assume willfulness requires a confession of tax fraud or malicious intent. But in civil tax court, the government has a much broader definition. The IRS can label you willful through three distinct paths: knowing violation, reckless disregard, and willful blindness. What is knowing violation? The first one. It means you knew the law. You knew you had to file an F-bar or Form 8938, and you voluntarily choose not to. What is reckless disregard? The second one. It means you acted with gross irresponsibility regarding your filing duties. You didn't necessarily mean to break the law, but you run an unjustifiably high risk of doing so. What about willful blindness, the third one? This is the one that catches people off guard. Willful blindness is when you make a conscious effort to avoid learning about the rules so you can claim ignorance later. Think of it like this. If you receive correspondence from an overseas bank talking about US tax compliance, like a FATCA letter, and you intentionally throw it in the trash without reading it because you don't want to deal with the paperwork, that is willful blindness. The law treats choosing not to learn the exact same as knowing the rule and breaking it. The IRS doesn't have a mind reading machine. So how do they prove what you were thinking? They look at objective markers, often called badges of willfulness. The most dangerous piece of evidence is Schedule B on your regular Form 1040 tax return. There is a line that directly asks, did you have an interest in or signature authority over a financial account in a foreign country? If you check no on that form, while holding active foreign accounts, the IRS views that as an active false misrepresentation signed under penalties of perjury. In a real federal court case called United States versus Hughes, the judge ruled that because the taxpayer filled out those specific boxes incorrectly in later years, her claim of not knowing was no longer credible. Here are the other warning signs. Moving funds between accounts to obscure patterns, or telling your tax preparer that your foreign assets are none of their business, or failing to act after receiving bank warning notices. So, what do you do if you realize your foreign accounts haven't been reported? The IRS has programs to help you catch up, but choosing the right one depends entirely on your intent. Important reminder, the information in this video is for general educational purposes only and does not constitute formal or legal advice. So, what should you do next? If your mistake was genuinely non-willful, you can use Streamlined Filing Compliance Procedures. You file your late forms, write a sworn narrative statement detailing exactly how the mistake happened, and pay a dramatically reduced penalty or sometimes no penalty at all if you live abroad. If you need help in your streamlined filing compliance procedures, book a clarity call with us. Email us at hello@usautax.com. But if your conduct borders on reckless or willful, the streamlined program is strictly off limits. Lying on a non-willful statement is a federal crime. Instead, taxpayers with willful exposure use the Voluntary Disclosure Practice, where you come clean, pay the steeper fines, and in exchange, the IRS generally agrees not to pursue jail time. The bottom line, don't try to draft these statements or choose a path by guessing, because international tax rules change quickly. Your safest first step is to always speak to a qualified, experienced international tax attorney to stress test your narrative before you submit a single document to the IRS.